And hello, everybody, and welcome to the Horowitz Company After Hours Pop-Up Q&A webinar for June 29th, 2020. Hopefully everybody's doing well. We are obviously coming off of some really interesting news, some items that have come down the pike over the last week, and we're going to talk about a lot of that today. Before we do that, I want to make sure that everybody understands that this is for educational purposes only. Nothing we talk about is a recommendation to buy or sell any security. Past performance is not indicative of future results, and we're not really providing any specific tailored advice for any specific investor or investment. So you can ask questions throughout this discussion. I really encourage you to do so. Any questions that are really more specific to a specific investment, though, hold that for a later date. We'll get to that. These are also recorded, and every couple of weeks we put them up on the disciplinedinvestor.com site, so you can check that out at your leisure whenever you're ready to do so, if you want to see the replay and know what's going on. So a couple of things to note. First of all, any questions that you have at any time, you can put them right in the Q&A panel. I think there's a little button on the bottom of your Zoom screen there that will allow you to add those questions. You can put them in at any time. We'll get to them in order that they're received. We've had some great questions over the last few weeks, so thank you very much for that. And as we mentioned, and I always say, it's there's nothing that's too small, or, well, I'm not sure if I should ask that question, or should I hold it for another time. Ask your question. That's what it's here for. That's what we're doing. We're answering questions. We're going over what's happening over the last week or so, some outlook, some things that are of interest, and then answering anything that you may have on your mind, whatever it may be. So with that, let's kind of do a quick recap of some of the things that happened since we met last week. So right now we're in the end of the month, coming into the end of a quarter. And I guess the best way I could sum up what usually happens in this time is that the horses are smelling the barn. If you've ever been horseback riding, you know that kind of you go around the trail and do your thing, and the horses kind of follow along with each other, and you can maybe give it a little direction here and there. But as they get closer and closer to that barn, they kind of like, okay, the ride's over. We're going, and we're just moving on automatically right back to the barn. Get this guy off my back, and let me get going. And when we talk about this with regard to markets, well, it's a time for window dressing, rebalancing. And this particular quarter, we talked about this last quarter, that there may be a pretty significant rebalancing that goes on. Those investment strategies that require a certain position in, let's say, stocks, bonds, real estate. Let's just leave it at those three for a second. Or even let's make it even more simple, and simplify it, I should say, as just stocks and bonds. Let's say there's a 50-50 requirement for stocks and bonds. And that's where you have to be, and you have a quarterly rebalance that happens. Well, this quarter we saw that there was a significant move, one of the best quarters going back many years for stocks after that historic drop that we saw last quarter. Well, that means that maybe stocks, let's just again use it as an example, are 54%, and the bond exposure has dropped down to 46%, right? So now what happens is that there's going to be a requirement to sell off the stocks and rebalance into bonds. It is mandatory, it is required, and that's what happens. So usually you start to see that pretty much going into the end of this week and in the beginning of the following week on either side a few days of the end of the quarter. Sometimes we have monthly rebalancings, but this is going to be a pretty big quarterly rebalance right now. Does that mean that stocks are going to sell off? Well, not necessarily. There's a lot of other things that are going on in the markets right now that are keeping stocks propped up pretty well. But this is something that probably will see some weakness towards the end of the quarter into the beginning of the new quarter as this rebalance goes on. And due to the fact that there is such an incredible outperformance of equities compared to bonds, for example, you're going to see that rebalance happen. So I think that's something to really watch right now. So over the last couple of days, we've had some big changes. We've seen a massive move in the infection rates and hospitalization rates. And a variety of underlying statistical data has shown us that there are a number of states that have shown a real significant spike in this whole coronavirus, much worse than was anticipated with any of the reopenings. We're talking about not only testing, but while a lot more testing has something to do with it, the fact is that it's also the positivity rate that's going on. That has caused a mini panic in itself. I will tell you that, and if you heard me talk about this, I spoke about this on the Disciplined Investor podcast this weekend. So I decided last Thursday that, you know what, down here there's an area by the Hard Rock Stadium where the Dolphins play that I'm going to go get a test. They open at 9 o'clock. You could just drive up, no appointment necessary. And I got there before 8 o'clock thinking, yeah, I'll get there early, right? Okay. So I don't see anything much going on. I go past, I drive a little bit longer. I see this line of cars. I'm like, okay, I'll get to the end of the car line. I drove about 1.5 miles, got in the line. It was like 10 to 8. By about 9 o'clock, I moved about, I would say about 100 feet, and figuring that this opens at 9, not a big deal. I'll wait it out. 9:15 comes. I moved another 100 feet. Then a police officer came by with their car with a bullhorn out of the car saying, from this location where my car was at the time, from this location, in order to get a test, there's a 4 to 5 hour wait. I said, really? Oh. Well, I immediately signaled and I took my car out of the line and started my drive back to the office. It was like 9:15 at that point. And I noticed when I looked over to another parking lot that I didn't see before, way back in the distance, that's where that line of cars was going into, and they were spiraled around like a Disney ride that usually has a few hour wait with all these cars. So testing, people are down here and a few other states are really going, pretty strongly into the whole testing area. And that is something that is increasing the overall number of cases. However, that only explains partially some of it, because we went from, in Florida as an example, a positivity rate, even though there was, tests going on, the positivity rate went from 4% a few weeks ago or a month ago or so to over 12.5%, close to 13% of the tests are now positive, which means that there is a much more pervasive overall infection rate. And that's why several states, including California and Arizona, Texas, and Florida, just to name a few, are halting the phased-in openings of various industries. So we just see that some of them are even backtracking a bit, closing down bars, closing down in-seating restaurants. Talked about a commentary from New York today saying they're very concerned about reopening and opening up restaurants for inside dining and malls. And in New Jersey, they decided today they're not going to be opening up inside dining at this point. So there's a couple of things going on, and we are seeing hospitalizations tick higher somewhat, but we also know they lag a bit by a few weeks. At least that's the data that is being told to us. We could argue this till all blue in the face. Fact of the matter is that we know that this is not quite over yet. And the real question why I mention all this is, what is the impact on the economy? What's the impact on markets? We saw some of that last week when Apple said they were going to close some of their stores. We saw that when new information came out of the highest amount of infections in Arizona and the spikes in Florida and in Georgia and in Texas and in California. And markets reacted they were very concerned. Now, you wake up a few days later, nothing really changes, and the markets decide, well, we're going to go up. Markets are up 500 points today on the Dow Jones Industrial Average, 1% or so across the NASDAQ, close to 1% on the NASDAQ, and 1% on the S&P 500. A slow start this morning that turned around very significantly and turned out that things were being bought that were being sold. The banks that were being sold last week were being bought today. The cruise lines are being bought today. The airlines are being bought today. Technology was sold off with the whole word about Facebook and all these advertisers pausing their advertisements due to the perceived hate speech and hate posts and social media not checking on what is going on, and all these advertisers started pulling out. So all of this was kind of put into the equation, and then buyers just started appearing. No rhyme or reason right now with markets moving up or down. There is the understanding that there is a tremendous amount of liquidity. We talked about that at length with the Fed. We talked about the fact that there is an underlying bid due to the fact that there's a belief that somehow this is temporary, which I find really amusing, by the way. You know, let's kind of, if you remember, back in March, the idea of a temporary slowdown that would last a few weeks, maybe 6 weeks. We were going to open for Easter. Let's get it all back open Easter. And, you know, markets priced in what that was going to be at that point. And when the realization was that we hit those lows on March 23rd, the Fed came in and it's only going to be temporary. That was the idea that permeated all of the minds of investors. And that was all that was talked about by analysts and economists. The second quarter is going to be really tough, but after that, it's all going to pick up really nicely. Well, hello, here we are, right? April 15th or so passes, Easter goes by. We start seeing a phased reopening of some places, slowly but surely. And then we see that other places are not opening up at all. And then we kind of fast forward to where we are in May. And now we're in the end of June. So this temporary closure, which has been maintained to some degree or another, pretty much everywhere. I don't think there's anywhere that's fully open yet. Some stores may be a little bit more than others, but we still haven't gotten back to it all where we were pre-virus. We were not, you know, the expectation of going from, okay, we're closed, to, all right, it's going to be temporary, we're going to reopen, snap our fingers, we're back. That didn't really happen. So markets are reassessing. You know, reassessing right now, well, we said we were going to open up quickly, and we we're going to have this phased opening, and it's going to go pretty smoothly. That was the idea. That was the thought and the hope. And this phased opening started moving into, wait a minute. Again, Apple closing down, Microsoft, not due to the coronavirus, but closing down all of their stores. Movie theaters, masks, no masks, masks again. Banks having some difficulty due to the fact that the Fed is pressing down interest rates and putting out last week their stress tests that were pretty intense. I mean, a significant amount of pressure they put on in these stress tests. And they said that, you know what? If we hit a 19% unemployment rate, there's a couple of banks out there, several banks, that may be having problem with their overall level of reserves. And as such, these reserve ratios that could become problematic, the Fed said, you know what? No more, buybacks aren't happening so fast. Dividends, okay, but if you're going to increase your dividends or change anything, or even some of the dividends you're paying now, what's really going to be all about the idea that it has to be based on another calculation. You can't just do it randomly. So the Fed is really putting some pressure on the banks right now. And it's a really kind of interesting environment in that we've really, I guess, socialized the banks. We've socialized the capitalistic world to begin with the Fed pushing money in. We know that. But the banks, pretty amazing. Last week on the news, banks sold off dramatically. This is a combination of the fact that we're having a slowing reopening process, a rolling back of some of the openings. And then on top of that, on Thursday after the close, the Fed releases their results of their stress tests. The ETF that covers the banking area and finance area was down 5.8% for the week last week. What's interesting to note, I think, in all of this, and if we haven't decided that there's going to be some choppiness moving forward, there is. It's a lot better choppiness. You know, we're not seeing continued down. I mean, yeah, the S&P 500 was down 2.5% or something like that last week, close to that. Same thing with the NASDAQ. Russell was hit a little bit harder. But it's not like we're just back to smooth sailing. And that can be seen very clearly by the fear gauge, right? The VIX remains elevated. I think it closed today at about 32, opened up at about 34, closed at 32. On average, 17, 18 is the average levels you want to see somewhere over a long-term period of time on the VIX. We were down for some time below 9 a few years back. That was kind of insane, but too much complacency at that point. Now we got to wonder whether or not there's too much concern. You know, and the people that put together the VIX, which are the traders that look at expected volatility over a period of time on markets, are saying, you know what? We expect a significant amount of volatility is going to be here for the foreseeable future. So I think we have to expect that as well. I don't think that's unreasonable. Now, whether or not that volatility is necessarily like we've seen it, which is kind of like, okay, we got a few percent down, then a few percent up, then a few percent down, not kind of going anywhere. Yes, we've seen from the highs recently a drop about 6 or 7% from the highs that we saw early June to where we were on Friday. So that's, a correction, a corrective action, I should say, and makes some sense. So I think that's a big issue that's going on right now. And there's a lot of other things that are underlying some of this too. So we have the virus we know about, right? Okay. Well, we know about the social unrest as well. And there's a lot of changes that are going on. I mean, we're seeing things like this new hatred to a degree, or at least a target of social media as the bad guy. Facebook, Snap, YouTube through Google, Twitter, and others are seeing that advertisers are pausing. Facebook being the one that's really front and center of all this. But they're pausing their advertising campaigns for a period. Now, how long is that? Could it be that it's temporary until maybe Facebook buckles and says, okay, we need to change the way we're doing things. We need to take out some of the hate speech and do a better job at censoring or culling some of the information that is misinformation, some of the lies and the things that target certain groups. Maybe that's something we shouldn't have on Facebook. But this boycott is going to hit them right in the wallet. And that's what it's intended to do. It's intended to tell Facebook, hey, listen, you know what? We've been dealing with this for a long time. It's time you clean up your act. And we all know the cesspool that sometimes we run into when we go on some of the social media. We all know it. You go on it, you have to kind of go through some of the misinformation or the rantings and ravings of lunatics on one side or the other side of the political spectrum. And, heaven help us, if you say something about a particular candidate or something of that nature, you're going to get a swath of hatred. So right now we're seeing that there is a further unrest. We have the social unrest with the Black Lives Matters, and we have the unrest in the markets due to the virus. And now we have the social media unrest that's going on with corporate America saying, hey, you know what? We need to protect our brand here. We're not really willing to put any more advertising on a site that sponsors or at least provides or allows for hate speech and terrible things that go on, separating people and causing an incredible amount of divisiveness within within our platform. So I don't know if it's something that it is possible that a lot of these companies were already thinking about pausing due to the fact that they are going to try to save some money in an economic downturn and therefore benefit their overall earnings. Companies like Clorox said today, you know what, they're not going to be doing anything till at least 2021. Microsoft has been pulling out on a regular basis. And Starbucks, and kind of go down the list, there's a whole list of companies that are saying, you know what, we're pausing at this point. We're just pausing. And we just don't want to be a part of this. I'm not sure what it's going to take for Facebook to turn around, because Facebook has decided for a long time that they are not going to be censoring. They'll allow the community to do self-censoring. But it seems to me that something's going to happen here, because it is, again, going to hit the pocketbook of these companies. And even with all of the negative news we saw today, on the heels of what we saw last week, Facebook was up almost 2% today, I think it was, by the end of the day. A lot of companies and analysts came out and said, that's not going to hurt them that much. I don't know what they're talking about. It seems to me that if these major companies, these Fortune 500, Fortune 1000 companies are pausing and they find it almost to be something that is necessitated because the other parties are doing it, it would seem it's going to be a problem for Facebook. The idea is that, well, if ads come down, prices come down a little bit due to this, there's going to be a lot of other parties that will be happy to take their place, smaller businesses, and advertise. At the same time, you have to wonder if smaller businesses have the money to do so right now with all that's happening. So there's a lot of cross currents, is my point right now. It seems to be getting close to a toppling point. I don't necessarily mean that as far as the markets. I'm just saying it seems like something's going to break here. You know, we have all these cross currents of all this stuff that's happening, and it's almost like, what else? What else can we possibly deal with? And at the same time, when I say that, I think to myself, you know, with all this stuff, all of this bad news, with all of these cross currents, look at how well the market has managed to weather that storm. Yeah, Facebook's down about 12% from its high. Not a big deal considering that it was an all-time high just last week. In an environment where we're going to be entering or have in at this point the worst recession that we've been in decades. So there's something interesting that I think is out there that I have to believe that, and we all know, there's the Fed really holding things up pretty well. So that's something that's not going to end anytime soon. The one thing that I will share with you, the one area of concern of mine is we're getting dangerously close to an income cliff at the end of July. Just in a few days from now, we're going to be, celebrating or not celebrating the 4th of July, Independence Day weekend. And many places have canceled their fireworks. Beaches are closed in Florida for the weekend. And you have to wonder that the federal $600 per week of additional unemployment compensation that has been in place for some time right now is supposed to run out on July 31st. So we're getting really close to that income cliff. And if it's not extended, there's been some discussion about not extending that, whether it's going to be in full or in part. And that has to be done rather quickly. And the Democrats want to put together and put forward their heroes bill for $1 trillion with infrastructure spend. A lot of Republicans are not really very happy with all that. And if we're going to have this infighting going on, what's going to happen to all those people that are relying on that additional $600 when we are starting to see further rollbacks, or at least not any further roll forwards or openings that are happening in many areas, particularly in areas that are involved in travel and leisure and entertainment, the restaurants, the malls, the retail establishments. I mean, it's a real big question right now, and we have to really wonder how things are going to be affected, because you won't be able to have a really solid economic recovery if you have a cut to those incomes. Now, we could argue all day about whether the $600 is the right amount or the wrong amount. It's too much, it's too little. Should it go further? Is it in a way, does it actually dissuade people from going back and looking for their job if they're making more money, or at least as much money as they did before? Should we be doing that in this kind of situation moving forward? I mean, we had to do something. So anyway, those are my thoughts for this week. It's a short week this week. Friday, the markets are closed. That means that while it is the first Friday of the month, the important jobless claims and employment reports will be provided on Thursday. One of the things we saw today, which probably did help the markets a little bit, was a pretty incredible, unbelievable number from pending home sales. We saw a 44% increase over last month. Now, of course, that's off of a low base, but nonetheless, that was a pretty significant number, back to 99 on the index, not near the high, but pretty substantial, with the knowledge that people are going out and putting contracts on homes. This is a trend that we're seeing, that there is this de-urbanization that's going on, and people want to get out of the metropolitan areas looking to buy homes. Plus, with interest rates as low as it is, it's very enticing for those millennials that are probably still living at home to say, you know what, or in apartments, say, you know what, maybe it's time to buy a house. And there's a lot of people in that genre and that age group that have the money now, that have gone through the process of getting a job, making themselves whole, saving their money, looking to buy a house, and with interest rates this low as they are now, makes sense to do so. So that was a really good number, that pending home sales today. I have no idea. If you asked me and you stood me over the side of a roof and said, give me a number for the unemployment, what is it going to be? How many people employed, unemployed this month? And what will the rate be? I couldn't tell you. The statistics are so odd right now that it's impossible. Last month, we saw a 2.5 million addition when everybody thought there was going to be millions taken off the payrolls. We saw the unemployment rate tick down when it was supposed to tick up. So if they did make corrections in the way that they asked the question, how they scored, and how they put the people that were out of work, not looking for work due to the fact that they were mandated not to return to work due to the lockdowns and the social distancing protocols and all that, then maybe we would see a significant increase in the jobless claims coming into this next reading. But again, I don't know if they're doing that or not, so I couldn't tell you. So we're going into this as open-minded. Let's see the data. Let's then take it apart and figure out what it all means. Already last time, I don't believe the data came out properly. I think there was some missteps by the Government Statistics Bureau that put this all together, the BLS, and it probably should have been a lot higher. We do view the unemployment rate as of the last month at about 16%, not the 13 and change that it came in at. So just a thought. All right, let's get to some questions here. As I mentioned, put your questions into the Q&A panel that is available. We have, I don't know, 3, 4, 5 questions, 4 questions right now. So we want to load that up a little bit more. Let me get to the first one. And our first question is, are there any resources, authors, books, or websites you'd recommend to get a good foundation in technical analysis chart reading outside of my book? I often watch your Trigger Charts Trade Station webinars, but they're a bit advanced for me. I get it. So there is a good book, a good friend of mine, actually. There's a few different books. But if you want to get a good feel with nice big charts and colors, and that may sound ridiculous to some, but I'm telling you, when I read the book, I'm like, hey, I really like how this book is put together. I think it's called Technical Analysis on Multiple Time Frames by Brian Shannon. Brian Shannon. It's a rather oversized book too, which is really nice. It gives you a lot of space to really look at the charts, and then he explains them on a regular basis with some very basic technical indicators and chart reading that is really there. He's a certified. He has a few designations that are involved with charting. I forgot which one he has exactly. But he's very good. He's been around for a long time. I've known him probably for 15 years. He's been on the show, The Disciplined Investor, many times. We go back and forth and talk about a lot of things. So I think it's called, like I said, Technical Analysis Using Multiple Time Frames. Brian Shannon. When you see the cover, you'll know it. It's bright. It has yellow, green, and red charts on the front. And I think you really like it. You should be able to get it on Amazon, etc. So there you go. Mike asks, what are your thoughts with target date mutual funds in a 401k? My company has Principles Lifetime Hybrid 2035 institutional, and I'm 52. So that's a really good question because a lot of people utilize them as a very easy way to go for, especially for 401ks. So I'm not the biggest fan of target date funds if you have the ability to understand what your risk factors are and, in fact, time horizon and where you should be. The one flaw about this is kind of a one-size-fits-all situation with regard to the way that they do it. And everybody, in other words, at this age range, okay, about, when approximately you're going to retire in 2035, is this level of risk as they put it in to their formula. That doesn't mean it's really appropriate for you, right? It doesn't mean it's necessarily right for you. So I would think that if you have the opportunity, and you can probably go out and find a good financial advisor that will do a review of the investments that are available inside of, you have Principal, you said, I don't know who exactly has the rest of them, but you could find somebody that will, for a few $100, to be honest with you, have them put together a portfolio for you based on the underlying investments that are there and see how that works for you. The reason is, like I said, this is going to automatically change over time for everybody that is, in fact, the same age as you, but maybe not the same risk tolerance. Maybe you at 52 have a higher risk tolerance or a lower risk tolerance than somebody else. And maybe it's not going to cover all the areas that you want covered. And it's going to naturally go more and more towards fixed income and cash over time, which again, may be right for you. But I'm just saying that my thought is that there is possibly a bigger advantage in you go finding a financial advisor for a fixed rate that will put together a portfolio and maybe revisit on an annual basis to see what's the best for you at that time. Things changed over time. We got some more room for questions just to let everybody know. Very quiet today. Everybody's kind of just hanging out today. So ask some questions, whatever you want to ask. It could be about markets, it could be about the Fed, it could be about the economy, it could be a general discussion about commodities, gold, whatever you want. If not, this is going to be our last question. Kurt asks, what is your opinion of the companies the Fed is buying bonds of? Apple, Walmart, Microsoft. I thought they were supposed to be help troubled companies. Yeah, kind of interesting, Kurt, don't you think? So what he's talking about is that the Fed recently made a decision that not only are they going to be buying bonds through their quantitative easing program of the United States of America, but they're also going to be helping out the bond markets. And as such, they're going to be buying corporate bonds and municipal bonds. Okay. Then they went as far as saying, you know what, not only are we going to do that, we're going to start buying ETFs. We're going to be buying certain ETFs of high quality corporate bonds to flush in liquidity into the system. Because one of the big problems we had going back, a few weeks, it feels like forever ago, but it was only 8 weeks ago, was the idea that there was a problem with liquidity. Companies that needed credit couldn't get it. And we're entering into not only a liquidity problem, but a solvency issue. And as such, what happened was that they said, you know what, we're going to start buying certain bonds of certain quality, and we'll do it through an ETF so that we're not picking and choosing which one. Then a couple of Fridays, they come out and said, well, you know what? We're going to actually go out and buy individual bonds. We're going to do it through an index style investment process. They have to meet certain criteria. We're not going to buy super junk, of course, and all that. And we find out the first tranche of what they bought was companies like Apple, Coca-Cola, Microsoft. Like, wow. Like, you really? How does that help out the bond market? I mean, is Apple going to default? Probably not, but okay, it flushes liquidity in. So what they did was they went after the safest bonds that they could in order to start building this portfolio of corporate bonds in an attempt to pacify the markets. And by just saying that they were going to do so, a lot of this has to do with the idea that the Fed will say things and it will move markets, and then they have to follow through. So now they follow through on this, and they bought companies that really had very little risk. So I think it's pretty ridiculous that they did that. I don't see the real benefit. I don't know that Apple needs to push out more debt so they could just rebound. So look at the companies here. You got Apple, you got Microsoft, those two right there. Serial repurchases of their own shares. Share buybacks like crazy. So the Fed basically, what did they do? They pushed money into Apple so Apple could take the money in and then buy back their shares. So what does that really mean? Let's think about that. The Fed really just, in a really oddball way, just took the biggest companies, the biggest ones in the indices too, the most heavily weighted ones in a market cap index, and just invested in them so they could pretty much buy back their shares, therefore boosting the market because they're unable to buy directly the stocks in the stock market. But this is kind of a backdoor share buyback program by the Fed. Crazy world we live in. Next question. What are your thoughts on the upcoming earnings season and impact of the overall stock market? So, yeah, to a point, analysts have dropped down their earnings estimates dramatically. Saw it tonight, two companies, Herman Miller, which you would think how much office chairs and desks are being bought right now, but okay. And Micron Technologies, chip company, both beat dramatically. So I think what's happening right now is there is going to be a very low bar to hop over, and that's the way the analysts like to do it. But you're going to see a lot of very wide beats and misses. pretty much from everything that we've read and everybody that I've talked to, this is a throwaway quarter. Nobody really cares what's happening this quarter. It's all going to be about the potential, which it may not happen, but the potential for guidance moving into the next quarter. So I think the bottom line of all this is that it's going to be a messy quarter. It's going to be a very messy quarter. And the reality is that when we look at the overall market impact, I think the market has psyched itself out to believe that it doesn't matter at this point. But we're going to see when push comes to shove and, you know, we get the real numbers, what it all means. Hopefully that clarifies that. Aaron from Canada. Is this the time before earnings to try diversifying internationally, Europe, Asia? I mean, we like the global diversification trade, but realize the U.S. is still the powerhouse in all of this. It looks like valuations are better outside of the U.S. And if the dollar just start coming down, yes, we're going to see a big benefit to things like the emerging markets. Asia has been just pumping and priming their markets for years. China just keeps on pushing more money in because a lot of the companies are owned by the state. Japan, quantitative easing forever is the way it's going to go, and they're buying, you know, into their markets as well. I think that I don't know if I would say before earnings or after earnings, Aaron. I don't know if that really makes a difference, but I do think diversifying internationally, which for you, I don't know if that means U.S., but for U.S., it does mean outside of the area in some emerging markets, possibly Europe to a degree, although I think they have a lot more problems, and Asia to a degree as well. John asked, does it seem to you that 90% of the charts since March have a cup and handle pattern? It seems like most charts I pull up look that same. Yeah, everything looks the same. Pretty much everything comes down to the 50-day moving average or the 200-day moving average, bounces right off in that Pavlovian response. We saw that with the S&P last week a couple of times. But yes, they do look the same. There is a lot in especially the big names and most traded names, a tremendous amount of index impact on those. So you look at the index, they look pretty much the same also. Cup and handle though, realize there's some specific things you need to meet for that requirement, which looks at a low volume, no undercut of the prior low, low volume on the handle, increased volume, and a breakout over the handle base, not the base, over the handle top on the upside for a buy signal, if in fact you ascribe to a cup and handle process that is from Investors Business Daily, for example. So just look that up and make sure it meets all the criteria before you kind of jump into that. It's a very powerful, it sounds silly, cup and handle, but it's a very powerful technical pattern that occurs, made famous by the Investors Business Daily group, William O'Neill, many years ago in some of his books. So that answers that. Another question, can you explain negative interest rates? I don't understand how they can be. Makes two of us. Probably makes 120 of us that are sitting here right now. So negative interest rates, the concept is this, that instead of issuing a bond, a company issues a bond and debt and says, you know, you are going to buy my debt. Here's $100,000, and I'm going to pay you for that 5% per year. And as such, sometime in the future, 10 years from now, I'm going to pay back the bond and everybody's whole, and you made 5% per year. Okay, that's a normal bond debt issuance, right? Well, think about a mortgage. You know, you pick up a mortgage, and what do you pay? You pay 5% per year until, you know, principal and interest throughout time, and then over time, you're paying the bank, and then the principal is brought down, and you pay less and less interest each year. But, you know, this is a kind of way that mortgages work. Negative interest rates are kind of the opposite here, where I issue a bond and you pay me for the right to invest in my bond. So exactly the same circumstances. Let's look at it. I issue a $100,000 bond to you. You say, thank you very much. You pay me 5% per year. Pay me 5% per year, or whatever the number is, to have the pleasure of owning my bond. At the end, I pay you back. I made all the money. It would be the equivalent of you having a mortgage, same 5%, but the bank paying you 5% per year to have a house. That's happening in some parts around the world. Crazy, insane. Markets aren't supposed to work that way. If you're the issuer, you love it, but it really throws finance on its head. It's being done, the idea of it is being done to help stimulate the economy by making sure that money is not held on reserve at the central banks, because if banks hold money on reserve at the central banks, they're going to have to pay interest on it as opposed to getting interest on it. And the central banks say, well, if we charge an interest rate and they pay us on it, well, what's going to happen is that they'll put money in the street. They'll get loans out there. They'll do more mortgages. They'll do some more activity to provide lending and create lending out there, which will stimulate the economy. Yeah, that's what they say. Also, what they say is, you know what a great way for us to collect money on all the bonds that we're issuing. They're making money on their bonds that they issue. The quantitative easing program is actually a profit center for them. It's insane. Totally insane. So I don't know how it works. I don't know how long it's going to stay that we could do this. I mean, you know, Japan has done this for a while now. Europe has done this for a while now. Several other countries around the world have done this. I don't understand how it works long term. Our financial system is so upside down over the last 10 years that it'd be amazing, you know, how it could be fixed and righted back to where it was when things were quote unquote normal. Yeah, and we have a quick comment in the chat. Somebody says, just a comment, there's going to be a long summer. Red market this morning to green this afternoon. Yeah, it's going to be like that. That's what I'm saying. That's why I mentioned the volatility of the VIX index at 32 or so, which is going to show this, you know, potential for volatility, both sides. You know, we're not just going to have those 0.2% days that kind of just, you know, open up green, hang out there all day. And just, I mean, we have a few of those, but generally speaking, we're going to have these washes down or up and then sold or bought throughout the day, then a wash down midday, and then a buy in the last hour. I mean, S&P 500 made all of its money back that it lost midday in the last 10 minutes of the trading session today. And then after hours, a lot of it's made also. It all happens at about 2 in the morning. You can have the opportunity to look at futures charts at about 2 to 5 o'clock in the morning. You'll see a lot of the movement through the day is pretty much encapsulated right within that time frame. So pretty interesting. Anyway, thank you so much for all of your great questions, and a couple of things to note. Of course, DH Unplugged tomorrow night at 9 p.m. live. Myself and John C. Dvorak will be there. Anybody has any questions, there's an email or a phone number right on the screen in front of you. Please use it. We're here to help. And what else did I want to tell you? The Disciplined Investor Podcast, pretty good discussion this week, I thought. There's some good artwork discussion last week. Artwork is an investment. And this week we just talked about all the things that are going on in the markets and a nice analysis. Until next week, I want you to be safe, be healthy. We're here for you. Any questions you have in between this week and next week, give us a shout and we will make sure to answer them. Thanks so much. Thank you, everybody. Have a great week.